What if I'm uninsurable? Man, we come across this, I wouldn't say a lot, but often over the course of a year as people are
Mhm.
looking to start policies. Anthony, what's a takeaway or two you got for this section?
Well, what I would say with this one, I think I don't know. I didn't spend much time prepping for this. I
Mm,
mean, we've had some content about if I'm uninsurable,
yeah.
and most of the time, typically when we're designing a policy, the goal is to design it for cash value, right? Not not really death benefit.
Yeah.
So if that's a goal, it doesn't really matter who we put the policy on because the cash value is still going to be the cash value. So if you're uninsurable, let's put it on a family member or a business partner, somebody that we have a relationship with.
Yeah.
I mean, because we're going to be able to solve the cash value problem. Uh, but and this is why oftentimes when we meet with somebody, and typically we meet with one spouse, I will typically encourage them to start underwriting on both. For one, maybe we do a term on one or whole life on the other, but this gives us options on how to design it. But also, sometimes one person is not um, insurable, so we
Yeah.
already have the other person already done or approved. What do you want to add, Cam?
Same, right? Nelson opens up this section by saying, not everyone is blessed with perfect health. That's true. We've seen that time and time again. And reading this section is actually had three kind of takeaways. The first one being in this section, he talks about parents buying a policy on their child,
Hmm.
and he references a policy on Jill, and he talks about the design. What I thought was interesting is he talks about a 50-50 design, meaning 50% of the total premium going to base premium and then 50% going to PUAs. So that got me thinking. And then I remembered back just a few pages earlier, on page 76, he presents a design where it's a 70-30 design, 30% base premium, 70 PUA. And then in the traditional kind of banking model that he starts out with on page 40, 40, 41, I think it's a 60-40 design. And
Hmm.
so he's shared three different, maybe four different designs over the course of this book for an illustration. And the takeaway I had there is, regardless of what people are saying out there online, is there's no right way to do it. Right? There's
Hmm.
kind of a range that is appropriate, but man, it's specific to the client. What's a good fit for them? So that was my first takeaway. The other takeaway that I had here in the bottom left of the page is he talks about taking money or income out of the policy. And what he touches on is he talks about surrendering up to basis and then switching to loans. So, what he means there is that when we're looking at an illustration or the life of a policy and we start taking income in retirement, uh, when you surrender up to basis, that means taking out what you put into it. And so you can do that. And that is a tax free event. So there's no taxation there. Once you get into your gains, then you're going to switch over into loans. And that's what he's referring to. So oftentimes you'll hear us, right? We're guilty of this, I would say, is saying that, hey, you can take tax free income out of it. Right. Specifically, there's a strategy to make sure that those distributions are tax free. And that's what he's referencing here. So, great point. I thought worth highlighting there. And then the last one that I thought was a great example is here he talks about the cash value on the child being greater than the death benefit on the dad. And so the dad's uninsurable. He's given an example of of starting a policy on a child, taking income, and then still having death benefit left over. It made me think of an example that I had a client a couple years ago that came in, and they had received an inheritance from the father's passing from a life insurance policy. And so the family had kind of a lump sum of trying to figure out what to do with it. And we looked at different funding options, whether we should
Hmm.
take that money, put it into a policy on the mom, or take that money and put it into a policy on the adult son. And as we were going through this process, is we noticed, right? I noticed that the cash value on the son after 20 years was actually greater than the death benefit on the mom after 20 years. And so I thought that was interesting, and certainly a case or a study of an example. What Nelson's alluding to is that it's not always best case scenario to put it just on the first generation is you do want to make sure you're looking at options there. So
you want to see the entire episode? Click here. If you want to learn how investors use infinite banking to increase their returns and lower their taxes, click here. If you want to see if infinite banking is for you and you have some questions, hop on a discovery call with us and one of our coaches. The link for that will be in the description.